Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill is joined by Don Steinbrugge, the CEO and founder of Agecroft Partners. With his extensive asset management and hedge fund background, Don offers an in-depth analysis of current trends in the hedge fund industry. This episode covers a broad spectrum of topics, from industry growth and investment strategies to the impact of ETFs and cryptocurrency. Don's insights into risk management, strategy sizing, and the changing dynamics of the hedge fund space provide invaluable perspectives for industry professionals and enthusiasts. Listen in.
Don Steinbrugge, welcome to Educational Alpha.
It's a pleasure to be here.
It's been a while. I've spoken at, I think it's Gaining the Edge conference a couple of years ago, and I know you've done a lot in this space. You're very thoughtful commentator on a lot of things, maybe my view, not yours. It seems to be gravitating perhaps toward hedge funds, although I think the aperture is a bit wider. But you do put out these top hedge fund trends. It's the asset class that people love to hate, maybe for the wrong reasons. And we're going to talk about maybe some of your observations there in a moment. But just by way of background, maybe you could just introduce yourself to the audience.
Sure. 1 minute. I've been in the business for 40 years, and some of the highlights of my career, I used to head up global institutional asset management sales for what is now Bank of America. And when I was there, we were the 18th largest money manager in the world. I was also in the executive committee of the asset management group. I also headed up institutional sales for Merrill Lynch Investment Managers, which has since been sold to BlackRock. And they were the third largest money manager in the world when I was there. And then I left and I joined a hedge fund called Andor, and we peaked as a second largest hedge fund while I was there. I was on the operating committee. I was a founding principal of the firm. And in 2017, I started Agecroft Partners. We're a hedge fund consulting marketing firm. We've been selected 12 years in a row as the top marketing firm in the industry. And we also put on a lot of events through Gaining the Edge and webinars, and we're write a lot of white papers on the industry.
Terrific. And my tenure is about the same as yours. I've been in this space a little over 40 years. And it's interesting. I don't know if that gains us an award or anything, but perspective and seeing a lot of businesses come and go. I did a stint at a subsidiary of Lehman Brothers. I worked with Bear Stearns. So it's very interesting to see how these players come and go. And I suspect that during your tenure at Merrill, it was not part of B of A. So it's interesting to be able to look back and not only see what's happened, but to be able to take that and look forward and bring better outcomes to the end investor, which is, I think, what you're all about. So I think the perspective that you bring is going to be great. So maybe getting right into it, top hedge fund trends, and maybe just start by industry sizing. And I think there's always this debate about whether or not it is an asset class or not. We could talk about that, but is it mature or not either? I think there are two sides of that as well. And we've got public equity markets in terms of market cap in the U.S. at 46 trillion, hedge funds of 5. You would think there's still some running room there, but maybe your views in 5 might not be the right number. That's sort of the anchor I've heard, but size and maybe your views on whether or not we are at a maturity point.
So hedge fund industry's grown a lot. When I first got in it, the industry was about $500 billion in assets, entire industry. So today it's 10 times bigger than it was at the turn of the century. And when I look at the industry, I look at all the various market segments. I look at pensions, I look at endowments, sovereign wealth funds, and what their current allocation is in hedge funds. And we're doing hundreds and hundreds of meetings with investors a year and just listening to, are you increasing your allocation? Are you not? Also looking at industry data. The net flows to the industry have not been very big over the past few years. And I think it's because we're close to a saturation point. That doesn't mean we're not going to grow. I mean, endowment funds are growing slow. They're getting bigger and bigger every year. There's more high net worth individuals that are investing through some type of platform and hedge funds. But I think most of the return is going to come from performance. But heck, if the industry grows 6 to 8% a year on $5 trillion, that's still significant growth for the overall industry, even if we don't have a lot of net flows coming in the industry.
Maybe, Don, you could make some comparisons if it's apt to the ETF space. And we did this seminal paper, I think maybe 2 years ago, about portfolio for the future. And Mark Anson, who you might know, did a comparison and maybe contrasted ETFs and hedge funds. And coming into the GFC, hedge funds were about twice the size of the ETF space, say 4 versus 2. And now it's the opposite. ETFs are 10 and hedge funds are 5. And his thesis is that the ETF space has cut up these risks into microcosms, and you can access these risks in a very finite way. And I don't know if that's maybe yielded or maybe contributed to the maturity of the hedge fund space. But what are your views on ETFs, and how does that correlate to what's happening in hedge fund land?
Well, just to show you how long I've been in the business, Mark used to be indirectly a client of mine back in like 2002 when he was at CalPERS. The way I look at portfolios is I look at beta and I look at alpha. And I think it makes a lot of sense to index large cap equities, either through index funds or ETF funds, because I think it's very difficult for long only managers to outperform the index. And you can get indexes for almost nothing. Most institutions or pension funds are going to have a majority of their money in long only mandates. So I could see ETFs and index funds having more money than the hedge fund industry. With that said, I think hedge funds are very valuable to help diversify pensions, endowments, foundations. I think it makes a lot of sense to have an allocation to them. So that's how I look at it. The fact that a lot of money's going into ETFs, it's not coming from hedge funds. It's probably coming much more from active management.
Maybe slightly off topic. I'm not sure if this was covered in the trends, but I think you've been publicly commenting on the SEC's final approval of these spot Bitcoin ETFs and maybe taking that back through the hedge fund lens. Where are we? What are you seeing about institutional adoption of digital assets? Maybe not so much Bitcoin, but maybe Bitcoin is the proxy today. And where are we, and how do you see that growing and evolving? Maybe not necessarily as a result of the SEC. I think you need more market depth, greater transparency, but curious to see how that's evolving.
So I'm very bullish on cryptocurrency long term. It is not going away. And it's more than just a currency. There's a lot of huge benefits that come from blockchain technology. There are some pension funds that have allocated to it. It's a very small percent. Like I know Fairfax County has an allocation to it. I know you mentioned Mark Yusko before. I know he's been a pretty big advocate of it. And I don't know if he has a fund of funds or how he's allocating to it. Obviously, Skybridge has been pretty big in that space. But overall, very, very few large institutions are currently invested in it. It's been very volatile up until the past few months that we had this massive sell-off. So I just think it's going to take some time for institutions, and it's also going to take some time for the hedge fund managers in the space to enhance the institutional quality of their offerings and for more investors to get into the space. So long term, I think they will have an allocation, but I think it's going to take a while for that to ramp up in the institutional marketplace.
And I saw Jamie Dimon is in Davos. We're recording this in second half of January, and he used a not so kind 4-letter word to describe Bitcoin yesterday. I don't know if you saw the interview, but he is very, very bullish, as am I, on the underpinnings of the blockchain and what that means for all digital assets. And it's kind of interesting with this ETF. I don't know enough about being pro or con Bitcoin. Certainly Gary Gensler's against it. But buying an ETF with a single asset hold is a bit unusual. So maybe this is a little bit, and I wrote a blog post talking about the analogy to the camel's nose in the tent. Maybe this is the camel's nose in the tent. And if we could have more assets running over these digital rails, I think it's going to lead to better outcomes. So maybe it is early days, but how do you contrast and feel about the distributed ledger technology versus what seems to be grabbing all the headlines, which is one virtual currency, i.e. Bitcoin?
So I think there are a lot of inefficiencies in securities associated with blockchain technology. The problem is there's not a lot of liquidity. And I think if the liquidity improves, it's going to be a great place for hedge fund managers to generate returns on both the long and short side of their buck. And part of what needs to happen is a very mature futures market. This ETF is going to add to liquidity. So it's an industry that's pretty darn big, but still in its infancy stage. And I think over time, it's going to be a great place to allocate. I personally am not allocating to cryptocurrency managers right now, and I'm not recommending people allocate to cryptocurrency managers. It doesn't mean they shouldn't. It just means that long-term I'm bullish. I'd like to see a little bit more liquidity so people can hedge it better. And eventually it's going to be a great place to allocate.
So we'll get back to planet Earth now, back to the hedge funds, more the garden variety type. So maybe what was not in there, or maybe I didn't read it closely enough, we're long geopolitical risk. And every new day, a new crisis comes up, it seems like. And I know that this has been a very good space for the global macro investor. I think the challenge of geopolitical risk, I think it is hard to model. But what is your outlook on the global macro strategy, just to start with, vis-a-vis all of this turmoil? And alpha is found in these pockets of great turmoil, and we're certainly long turmoil as I look out on the horizon.
First of all, what I would say is if the market's just going to keep going up 15% a year and there's no risk to the market, you probably don't need to invest in hedge funds. Just invest in the market. With that said, I think the market's very expensive. When you look at volatility, volatility is low. Most people are not worried about everything that's going on in the world. And usually when volatility is really low, that's kind of near the top of a market because you have all this optimism that it doesn't take as much to cause the market to tank. So with that said, it's probably not a bad time to have an allocation to global macro. It's probably not a bad time to have an allocation to CTAs. CTAs do very well when volatility spikes. So a lot of people were shocked that the market was up 26% last year. And now people seem way too optimistic on the capital markets. And when everybody's optimistic is when you should increase your allocation to hedge strategies.
I agree with all of that. And maybe this gets back to some of your trends. So none of us can time the market. And I think that volatility is low for the wrong reasons. I think that we're complacent. We expect the Fed to bail us out, interest rate cuts, and everything will be fine. And some of these crises we see used to immediately result in a spike of volatility, very high correlation. We seem to be ignoring that. So if you and I are right on that, it would mean maybe de-risking the portfolio, lowering your drawdown risk, lowering your volatility. But then it gets back to this 20% churn that you mentioned in the hedge fund space. So every year, 20% of this 5 trillion is turning over again. And it's hard to time when you want to put on that trade. But if you're going to put it on and then halfway through this year, the market's up 12%, you take it back off again, put it back on. Are we lacking a long-term lens when we think about allocating to hedge funds?
Well, first thing I would say is I think most people don't understand risk. They don't understand correlations. They look at their portfolio. They look at what the standard deviation has been in different components of the portfolio. And a lot of that doesn't matter. All that matters is when you have a big sell-off, what happens? And when you have a big sell-off, volatility tends to spike for most strategies. Correlations tend to go to 1. And so when you're modeling the risk of your portfolio, it shouldn't be trying to be on the efficient frontier based on what the average standard deviation and correlation should be. It should be what happens if we have another 2008? Can I live to invest tomorrow? Some strategies are negatively correlated and they become much more negatively correlated when the market sells off. Other strategies just don't have any correlation in the marketplace. And that's why people want these. And back in 2008, pension funds got hammered in their asset allocations. And that's when they really saw the benefit of being diversified into hedge funds. So one of the things people should do is look forward, don't look backward. Strategies that do well in rising volatility, they might not have done that well over the past year because volatility has come down. That doesn't mean you shouldn't invest in them. It means they're probably a better place to be today than they were a year ago. When you look at manager turn, and I estimate it's about 20% of the industry a year is kind of moving around. I mean, it's probably over 50% due to performance differences for a manager within a particular strategy. I mean, if you're generating bad returns relative to people who do what you do, people are going to fire you and hire another manager. Most of it's probably going to stay within that strategy. Some's going to shift. And then the second question is a lot of money shifting back and forth between strategies with people trying to time the market? I think it's a smaller percent of the overall industry. I think a lot of people have certain allocations to strategies that they tend to be moderately stable to those allocations over time.
And when you see, and this is going back a little bit, Don, but it plays into another one of the trends you mentioned, a CalPERS saying, I don't invest in hedge funds anymore. And we've seen a lot of large pension plans say that. But I'm not sure if the common media or maybe CalPERS even understands exactly what that means. And I assume CalPERS does. It doesn't mean they're not in the business of hedging risk and diversification. So what are your views on allocating to an existing commingled hedge fund structure versus a managed account or a fund of one where you're trying to solve for a very, very specific risk and you can hire a manager to do that for you? You probably have to be a larger plan to do that, and CalPERS certainly checks that box. So are you seeing more hedging and hedge fund type exposures being gained in these funds of one or in managed accounts?
So let me first touch on CalPERS. They were the first public pension fund to make a direct hedge fund allocation. Before that, all the public pension funds that did invest in hedge funds went through a fund of funds. And CalPERS is a highly political organization. And they've had some major compliance issues with employees at CalPERS. When they decided to exit hedge funds, I think it was more political. And there were all these articles in industry that said, oh my God, CalPERS is getting out. Everybody's going to follow CalPERS. And I'm not aware of anyone that followed CalPERS within 6 months after CalPERS exited. And the reason they didn't is it just made academic sense to allocate to hedge funds. You know, you've seen some high profile pension funds after that get out, but it's not a lot. And when you see them, they get headlines in the industry. When you see people adding hedge funds, no one mentions them. So the mainstream media tends to be biased against hedge funds, and they're going to publish the negative stuff, but not the positive stuff. Now, I've been doing this trend piece since 2008, and I talk to reporters, and they're all like, no one likes hedge funds anymore. The performance is bad. The industry's shrinking. And one of my top trends every year is the industry's going to hit an all-time high in assets. And that's because it's not true. I just don't see all these people leaving the industry. The industry grows because of performance. You asked a second part of the question. I can't remember what.
I think this is a great lead. And it's if I've got the size and the scale, and I think we've moved on for the most part to fund of funds, to individual hedge funds themselves. But am I better off in a fund of one or a managed account to solve for something very, very specific around a risk I'm trying to either negate or tone down in my portfolio?
So I'm seeing a very strong trend towards separate accounts and fund of ones for very large investors. And I don't think that trend is going to reverse. I'm surprised the trend didn't start a long time ago. And the reason I say that is the first 18 years of my career, I was in charge of selling long only, fixed income equity, non-US equity to big pension funds, and it was all separate account. They never invested in a fund. So then I transfer over to the hedge fund industry and everything is in the fund. People were very reluctant to do a separate account. It's not that hard with technology today for a hedge fund manager to do separate accounts and run money in a fund. So maybe the very large managers with the strongest brands can get everybody to invest right in their fund. But I think most small and mid-sized managers need to be open to managed accounts, and they probably need to begin to lower the minimum amount for a separate account in order to be as effective as they possibly can raising assets.
Yeah, I agree with all that. And I'd be curious your comments, Don, on separate account versus a commingled fund. And even if they're managed pari passu, if I believe in the strategy and I'm executing it through a commingled fund that's got liquidity provisions either daily or quarterly, there's constantly people coming and going. And if I'm dealing with an overall 20% churn that we talked about before, that has some form of impact on my returns because it's part of the collective corpus. So how big or how much, if at all, is that an issue where the liquidity window is being opened for somebody else and perhaps a drag on the strategy I expected to be fully invested in?
So the issue with the 20% churn is it tends to be concentrated to a much smaller percent of managers. There tends not to be a lot of volatility in flows for a manager. They tend to be either gaining assets or losing assets. So I don't think it's as a big of an issue. You also got to consider like the liquidity of a strategy. If it's a less liquid strategy, it's much more difficult to do a managed account. That's probably going to be done more by a fund to one, which is controlled by the hedge fund manager. For long short equity, I think that's where you see a lot more interest in managed accounts. And some people don't allocate all the cash to the account. If you're not fully invested on the long side, let's say you're 75% long on the long side and 35% short on the short side, you're going to have more in cash, and they might want to use that cash for other things in their portfolio. They may want it to do better risk control through their analytics, having greater transparency on the securities. So there's a number of reasons people want a separate account. I think there's always going to be demand for the commingled funds for smaller investors. Because if you're a smaller investor, it is a pain in the neck setting it up. Then you have additional fees that are allocated to the separate account. So it has to be a certain size to make it beneficial to have the separate account.
And maybe just as a follow-up to take this to maybe, I don't know if it's an extreme level, but coming out of the GFC, we took some of these very sophisticated strategies that were managed in private funds with very little regulation, no regulation to some degree, and not a lot of transparency around holdings. And we said, well, let's bring this to the masses and cram it into a 40 Act fund with a tremendous amount of regulation, daily liquidity, full transparency, limits on leverage, limits on illiquidity. And how's that going to turn out? I think all things being equal, less well. How much less we can debate. But as we think about democratization, I think we have a tendency to give the investor what they want versus what they need. They want liquidity on demand. But if you look at the liability side of their balance sheet, and if they're 40 years old saving for retirement, that's not a risk they should be focused on. And they're going to give something up if they want liquidity on demand. So does the wrapper matter? And is a 40 Act mutual fund a productive wrapper for a hedge fund if you allow this daily window to come in and out?
I am not a fan of 40 Act funds. I think the returns for 40 Act funds have not been good. Mutual funds aren't very good. Very few mutual funds outperform an index over long periods of time. And I think you get what you pay for. I think the probability of getting very strong risk-adjusted returns is much better in a hedge fund than it is in a 40 Act fund.
I agree. So I want to finish with emerging managers because I think there's a couple of interesting doors to open there. But one last thing before we go there, when I think about a maturity of any space or any product, it usually means the buyer has a better optionality on fees. So what are you seeing? Is the 2 and 20 still alive and well? Is it alive and well for the smaller manager, but the bigger allocator has more negotiation power. Lower fees are more alpha, clearly, so it does matter. But I think you touch upon fees in your trends as well.
So I'll talk about it from two different perspectives, the investor and the manager. From the investor side, I think there's a bifurcation in fees. If you're an investor that is allocating 1 million, 5 million, 10 million, there's not a lot of flexibility in fees unless you're going to a very, very small manager that really needs your money and is willing to negotiate. If you're a large institution, if you don't negotiate, it's hard to get the business. That may not be true for the very large managers with the famous brands, which probably is not the way you should go anyway, because a lot of them have way too much money and it's hard for them to generate alpha because their alpha is diluted over a large asset base. But for most other managers, there's significant negotiation and fees for a $100 million account. The average is probably closer to 1 in 10. If you have limited capacity, you can get a higher fee. And I talk about 100 million. One of the things I find really interesting is just what's happened to pension funds. I told you before, they started with fund of funds, then they started going direct. And when they went direct, they only hired the largest managers. And they've built out their staffs, they've increased their sophistication. There are a lot of very large pension funds that will allocate to a hedge fund organization with 50 million in assets. They're sophisticated enough to see that you're able to create the alpha, but then they're going to want to significantly negotiate fees with you, and they often want a separate account. So the good news is small funds can go after these big asset pools. And if you have unlimited capacity, getting 1 in 10 is not a bad deal if you get an account that big. A lot of small managers are obviously doing founder share, where they have significant discount fees until they get to a certain level. It used to be cut it off at 100. Now I think you got to go to 200 in order to get critical mass. So when you look at large mandates, there are basically two different strategies. One is just to negotiate fees, but now you have all these most favored nation clauses, so it gets more and more complicated the more you do. And then other managers have a tiered strategy to fees. And it basically says for accounts 0 to 25, maybe you pay 1.5% management fee, and between 25 and 50, maybe it's 125, and 50 to 100, it goes down, and above 100, it goes down further. And that allows you to not negotiate as much. You treat everybody the same. And it's also how the long only world is. The whole long only world has a tiered fee structure where your fees automatically are lower the more assets that you invest with a manager.
So I think when in doubt, I guess if you're in a fund, the room to negotiate may be more difficult, but when in doubt, ask, I guess. Nobody should be going into a car dealership and paying the sticker price. So I think it's good advice. And certainly we've seen the same thing, that the fees are certainly tracking downward. So emerging managers said a few doors to open here. And before I get to emerging managers, because size is a consequence of emerging managers, I would think, Don, all things being equal, a smaller fund is better than a larger. And I say that maybe anecdotally in that they're operating in a less efficient part of the market. It's easy to put trades on. This great inefficiency, which, as I said, yields the alpha. It's probably more nuanced and complicated than that. But what is your take on large versus small manager to start with?
So in general, smaller is better. If you look at long-term returns of hedge fund indices and you divide it up between large managers and small managers, the small managers have done much better than the large managers. It's not true for every single strategy. I mean, some strategies may need a lot more infrastructure, a lot more analytics, but in general, there are more inefficiencies with smaller cap stocks than there is with the Apples of the world. But if you're investing in small cap stocks, you're limited to how much capacity you can take in. Same with fixed income. There's a lot of less liquid, smaller fixed income securities that you can generate pretty high returns on. But if you're managing tens of billions of dollars, you can't allocate to those. So people should take into consideration size. There are a lot of really prominent managers that if you look at their track record the past 5 or 10 years, it's not very good. It might have been good in the 90s or maybe the first decade of this year. And when you speak to a hedge fund manager and you ask what your capacity is, most are going to say it's much larger than what it should be. If you go to these huge hedge funds and you say, are you at capacity? If they're not at capacity, they're going to come up with some explanation on why they're not. So I think you have to take a step back and do your own estimates on what the capacity for a strategy should be.
Yeah, and I think if you're looking at a track record and the 5, 7, 10-year numbers look very good, but the vintage of the average investor is 3 to 5, those 5, 7, and 10-year numbers really matter. Maybe they're a bit a relic. So moving further down this path, there might have been a Chatham House rule, but maybe not, but I won't give attribution. But I was at a large conference late last year, a lot of very senior, sophisticated delegates, and there was a pension consultant panel. And as the story goes, let's talk about private credit. And we're done talking about private credit. Let's talk about private credit. And then, hey, have you thought about private credit? That's all they talked about. So after 40 minutes of this, it opens up for Q&A. And I put my hand up and say, hey, I think all investors are sitting back and thinking about maybe two things, volatility and drawdown risk. And the solution for that is hedge funds. And it's amazing in 40 minutes, the hedge fund word or words has not come up. And the answer I got floored me. It was, well, all the good hedge funds are closed. And I'm sort of sitting back and saying, well, I guess God stopped creating hedge fund managers 10 years ago. So I think there's this view, and I think you started this conversation a moment ago with some of your observations, Don, that there's this Hall of Fame club, and that defines hedge funds. And I think we forget that there are a lot of talented managers out there. I don't know if it's career risk or something else, but curious to get your observations on that point.
So this is what I would say. I would say 5 to 10%, maybe close to 5, of hedge funds, I think, are best in breed. Now, you might say, oh, Don, that's just terrible. You're saying 90 to 95% aren't good. Well, I think it's a smaller percent of mutual funds that are good. If you're an investor, you have to do your due diligence. You just can't randomly invest in any hedge fund that's out there. You got to look at the quality of the company, look at the people's bios, make sure you understand the investment process, what inefficiencies they're going after, what their differential advantage is to capture that, risk controls, look at track record. When you got 15,000 hedge funds, 10% is 1,500. 5% is 750. There are a lot of really good hedge funds out there, but it does take a lot of work to screen through them and find them and do research. And those who do, I think, can find really good ones. I think the most sophisticated investors invest in the small, mid-sized managers. Anyone can hire the largest managers, the most famous in the world. How hard is that? I'm going to invest in the top 10 largest hedge funds. Someone in 8th grade can do that. Finding the diamonds in the rough that are focusing on these inefficiencies that aren't at capacity, that have a higher probability of generating returns going forward, is where people's efforts should be focused.
And maybe as a final observation on this and pulling in, I think, another one of your trends, I talk to a lot of these emerging managers, and I don't know if that's defined by assets, time in this space, but typically this is maybe well below a 500 million, maybe 100 million, 125 million. And they may have a good track record. They've got the right apparatus. They just can't get that breakthrough. And the constant question is, how do I do it? And certainly the numbers have to be there. The risk controls and operational infrastructure have to be there. But marketing your brand and distribution are probably as good as the basis points you're putting up as well. And I think, again, with these emerging managers, it's a little bit of the chicken and the egg. They can barely pay their salaries, and you're saying, go get distribution. So what would your advice be to the emerging manager that has pretty good numbers, but it's just been stuck at 125 million?
Well, the first thing I would say is we just signed up a client this past summer, and in their strategy, they had about $65 million. I think they had like an 8-year track record. And I think we're going to raise maybe $1 billion for them over the next 12 months. They are becoming really hot. There's huge demand. There are a lot of people that are looking at making $100 million allocation to them. And so how do we do that? Well, one thing is it's a very good fund, meaning people use multiple valuation factors to analyze the fund, and they ranked really well on all of them. when I first met them, their presentation wasn't that great. So people really didn't understand what their edge was, what the inefficiency was, how they were able to get an edge and capture that inefficiency. And we completely redid the presentation, made it easier to understand, made it very linear. And then we also help because we have a great brand and people trust us. When we bring a new manager, people look at them. But to really raise money, you got to have a great product. And if you have any weaknesses, you got to fix them. You have to have a great, concise, linear presentation, and you have to penetrate the marketplace and be patient. And it's not a transaction business. It may take 6 months. It might take 3 years to land an investor, and you can't try to sell them. It's bought, not sold. And if you approach it that way, then there's no excuse not to raise money.
I think good advice and a good way to maybe wrap this up. So, Don, thanks for joining me today. Thanks for keeping on an area that I think is maybe not covered so well. The FT is not a big fan of hedge funds. And I think your job, too, is not to be a cheerleader, but be open and frank about both the opportunities and the risks. And I think you strike a good balance. And you've also been a frequent contributor to our content, and we appreciate that as well. So thanks for coming on, and I look forward to seeing you somewhere in the world in 2024.
Great. It's good seeing you. Cheers.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.